Hey everyone, welcome to Alpha Insights. I'm Kurt.
And I'm Jeff. Lots to dig into today in the tech and AI world. We've got ad tests, data center moves, chip supply shifts, and even a few IPO and legal headlines to parse.
Let's start with the biggest, most headliney bit. A major AI platform started selling ads inside its chatbot this morning, and it's charging advertisers per ad view instead of per click. They're asking for relatively small initial commitments, under $1 million, which feels like a cautious way to test demand.
Right? And that matters because it's an early real-world test of whether conversational AI can make money directly from ads, not just from enterprise licensing or developer APIs. If brands see return on investment from chat-based placements, that opens a scalable revenue stream for platforms.
Exactly, but it's not just about the ads. The same company also told communities it will pay for energy upgrades at its data centers and limit how much water those facilities use. That's a smart move to blunt local opposition. It's basically trying to smooth the path for future capacity buildouts.
Yeah, that operational pledge is as strategic as the ad push. Local communities often fight large compute facilities because of energy and water strain. If these platforms cover upgrades and cap water use, regulators and neighbors are less likely to block expansion, which helps the whole AI ecosystem scale.
There's a neat connection here. Monetization on the revenue side and fewer local hurdles on the infrastructure side. Both make AI a more investable theme. But it's still early and ad uptake could disappoint, so investors should be cautious.
Agreed. Watch how advertisers respond. If brands don't see measurable conversions from chat ads, the pricing model will have to change. Per-view pricing only works if engagement turns into sales or meaningful signals for marketers.
Switching gears, AI adoption in institutions is moving from experiment to practical use. For example, a few universities are using AI to score essay questions and reported big-time savings. One school estimated roughly 8,000 hours saved during admissions.
That's a good example of operational efficiency you can point to. When universities and similar institutions start saving time and money with AI, they become repeat buyers. And platforms respond by building features like age prediction tools to limit exposure for minors. That's part of showing responsible use as regulators watch closely.
So you're seeing practical wins on campus and safety features on platform levels. Those both help the regulatory narrative, which is important for long-term investor confidence.
On the chip side, there's a noticeable push towards supply chain localization in Taiwan. Companies from steel to plastics to display makers are moving closer to semiconductor production. That could strengthen regional resilience and be a medium-term positive for big foundries.
For investors, that means keeping an eye on capital spending. If foundries and chip makers accelerate spending to localize and expand capacity, equipment suppliers and industrial vendors could see a lift. But that's dependent on guidance from earnings calls.
And geopolitics is the wild card. Localization reduces some risks, but it doesn't erase the potential for trade tension to disrupt flows or raise costs. So it's not a free lunch.
A couple of smaller but telling market signals. A cloud TV software company listing in India opened about 12% below its IPO price, which suggests selective appetite for niche cloud infrastructure names. And a social platform settled an addiction-related lawsuit, which removes one legal overhang but doesn't eliminate regulatory risk.
Both of those are reminders that the market is picky. Big, established names get more benefit of the doubt. Smaller IPOs may need clearer revenue paths and stronger narratives to get bought up on debut.
Before we wrap, let's highlight the 3 catalysts to watch closely. 1. Advertiser feedback and how ad pricing holds up in chat interfaces. 2. Chip makers' earnings and capital spending plans. That will tell you whether localization translates into demand for suppliers. 3. Legal and regulatory moves around platforms and AI safety. Those change the risk premium quickly.
And quick risk checklist: slower than expected ad uptake, rising energy costs if infrastructure promises aren't met, weak appetite for small IPOs, and geopolitical shocks to supply chains. Those can all hurt positions tied to these themes.
So what's the takeaway for listeners building portfolios? Prefer diversified exposure to cloud and large foundries, watch CapEx and advertiser metrics, and keep some cash for opportunistic entries if volatility shows up.
I'd add, for active investors, consider selective plays in platform monetization and big cloud infrastructure providers, but avoid over-allocating to headline-driven small listings until we see consistent demand.
All right, quick summary together. Jeff?
OpenAI's ad test is a meaningful first step toward direct monetization, and the data center fixes are meant to ease expansion. Universities adopting AI show real efficiency gains, and Taiwan's localization push could help chip supply resilience over the medium term.
Meanwhile, watch advertiser ROI, chipmakers' capex signals, and regulatory developments. Be selective, favor established names, and keep some dry powder for volatility-driven opportunities.
For more market insights and written notes, head over to stockalpha.ai.
Thanks for listening. We'll be back with more on how these tech trends unfold and what they mean for portfolios.